So let's have a look at corporate tax and business taxes. So the first thing I want to mention is back in March 2021, Rishi announced an increase to corporation tax from 19% to 25% from 1st of April 2023. There are no further amendments announced yesterday, but it does mean that rise is likely to take place. There is a small company rate of £50,000 and beyond £50,000 as you reach up towards £250,000, the rate rises from 19% through to the full 25%. This means there's a marginal rate of tax of 26.5% for profits between £50,000 and £250,000. And please bear in mind that these limits are split between those companies under common control, i.e. associated companies. So what does this really mean? Well, it means the first 50k of profits remain at 90%, and between that and 250,000, you will see from this chart that the effective rate of corporation tax increases up to the total of 25% when profits reach £250,000. Historically, you can see here, right back in 2008, we had a 30% rate of corporation tax. That's been nosediving down. It was due to be reduced down to 17% in 2020, but there was a U-turn on that, and we're now pushing back up to 25% from 2023. But you can see there's a distinct change in the rate of corporation tax from the last 15-year period. How do we compare around the globe? Well, currently, the UK has one of the lowest CT rates in the world, almost as low as Switzerland, which obviously is known as a tax haven. Many of our neighbouring countries, including Germany and France, have significantly higher corporation tax rates. And how does that look after April 2023 when our rates increase? Well, I think we will still have the lowest rate of corporation tax in the G7 countries. Remember, the actual rate of corporation tax will be lower if your profits are below £250,000, and that obviously isn't demonstrated on this slide. And my only other observation here is that we are in the middle of a worldwide COVID pandemic, and it may well be that other nations seek to increase their corporation tax rates above and beyond where they are at the moment. Certainly the US, we understand that there are increases pending. Trading losses, these were announced again back in March and no real changes, but I wanted to highlight the fact that these apply to accounting periods between the 1st of April 2020 and ending in the 31st of March 2022, which is not far away. It gives the ability to carry back trading losses in a far more flexible environment than historically. There's an unlimited cap back for 12 months and then the cap of £2 million to the earlier 2 years on a last in, first out basis, but that 2 million cap does need to be split amongst group companies. So again, you need to look at companies which are 51% subsidiaries or more. For unincorporated businesses, similar rules exist. A £2 million cap and unlimited going back to the immediate preceding year. And the 2 million is a personal loss limit regardless of any partnership level of loss, if indeed this exceeds £2 million. Let's hope losses are not of that magnitude. Capital allowances, an announcement yesterday is that the current £1 million AIA limit has been extended. It was due to end on the 31st of December 2021 and has now been extended through to the 31st of March 2023. This is welcome news, but it has sort of been extended several times previously, so I think we were possibly expecting it. For non-AIA qualifying assets, these remain at 18% and 6% respectively, depending upon the type of assets. There is also SBA, the Structural Buildings Allowance, which is a 3% deduction, but enhanced where you have a Freeport site. And remember, with an SBA, virtually everything covers apart from the cost of land itself and the costs associated with its acquisition. If you come to sell the site and sell the building, then there's no balancing charge. The remaining assets, the remaining allowances, I should say, pass on to the purchaser in the normal way on a straight line basis. Back in March, they announced the super deduction that basically enables people to obtain 130% tax relief on assets that are acquired. They have to be new assets, not second-hand assets. So if you're buying second-hand assets, the annual investment allowance is very, very useful because you won't get the enhanced 130%. And remember that if you're getting tax relief at 130% when you buy something, when you come to sell it, you need to pay tax at 130% of your proceeds. And with corporation tax rates rising in 2023, there are some conundrums there to think about as the timing of when you make your acquisitions and your disposals. Capital allowances on cars, I just wanted to highlight there. Sam was talking about COP26 and everything around that and our carbon emission programme. The availability of the 100% first-year allowances is extended to April 2025. And remember here that you need to purchase zero-emission cars to get 100% capital allowances. The rate previously was under 50 grams per kilometre of CO2 emission. And remember that cars do not get the super deduction, and neither do they qualify for annual investment allowances. Research and development, not an awful lot has changed here. The pay-as-you-earn cap is now enforced from April of this year, but R&D continues to be a valuable tax relief. For a small and medium enterprise, it's effectively a 25% tax deduction where you're profitable and a 33% deduction and tax break where you're loss-making. The headline here, though, is that the government want the UK to build and grow its R&D initiatives and activities and continue to promote these annually. It is great tax relief. And you'll see from this next slide that the numbers of claims have doubled in the last 6 years. And I think it's also fair to say that quite a big proportion of those claims are quite small, but still very worthwhile. We do know there are some changes afoot from April 2023. And these relate to cloud computing and data costs. So the costs of acquiring, cleansing and manipulating data for the use in R&D, particularly important in machine learning activities, will be extended so that they qualify. And it's also expected that from April 2023, only expenditure incurred within the UK will qualify for R&D tax relief. This is a similar situation for R&D tax relief in Switzerland, the US and other jurisdictions, so I don't think it's unwelcome and it feels quite justified. Let's look at profit extraction, because profit extraction from a company is a really big question and something we spend a lot of time advising our clients as to the most effective route between a dividend and a salary. Usually the most effective route is to have a small salary and then a dividend to top that up. But over the next 2 years, we've got some challenges. We've got an increase in national insurance, we've got an increase to the dividend tax, and we've got an increase to the corporation tax from April 2023. So let's consider some examples as to whether this changes the balance. So this first chart looks at a profit of £50,000 before corporation tax, and it works on the basis that you're trying to extract the very maximum amount of that £50,000 into your bank account. It assumes there's no other sources of income and a minimum salary and to achieve the national insurance entitlement, and the balance is then to be extracted by way of dividend. At this current level, the effective rate is around 19%, and you end up with £40,664 in your bank account. So what happens from April next year when we get the 1.25% increase? Well, this actually changes by about £400. There's an additional duty of about £400 payable. We don't need to take this to affect the corporation tax rate rises in April 2023 because they won't affect this profit as it's only 50,000. It'll only be profits above that. But if you take this further to £100,000 profit, what does it mean? It means a similar principle. At the moment, we've got a 30.25% tax rate. That increases to a 31%, an increase of £900 at April 2022. At April 2023, what does that look like? Well, that actually means that there's a further increase at this point of £900,000. Sorry, £900. It does show, if you just flip back on those slides, that you can see the rates are changing and there's more tax to be paid. So looking at £250,000 profit, what does this mean? Well, this means the current effective tax rate is 42.75% at a cost of £107,000. Next year, this increases to 43.7%, an increase of about £2,000 in real terms. But the following year, it goes up £11,000 in total. So the higher the profit, the bigger the impact. This is what we were expecting. When you also look at the extraction by way of dividend or salary, this chart shows a slightly different way of looking at things. It looks at the cost of extracting £1,000. The current rate, you will see, it's most effective for a basic rate taxpayer to take a dividend rather than a salary. And from April 2022, those principles still remain. But at higher and additional rates, the gap starts to close slightly. If you take this to another level and you look at marginal rates of corporation tax or the higher rate of corporation tax at 25%, what does this mean? It means that if you look at a 40% taxpayer and a 45% additional rate taxpayer, that the cost of extraction between dividend and salary is almost the same. There's hardly any difference. Basis period reform. This affects self-employed and partnerships. This is meant to be a simplification. It's needed for the introduction of the Making Tax Digital regime. It's currently where there is a 12-month accounting period, you are taxed on a 12-month accounting period which ends in that particular tax year. These changes affect from April 2024 and align the basis period to the tax year. So if your accounting period is not currently 31st of March, you will need to be prepared and plan ahead. So in 2023-24, the final tax year, this is the year of the old tax rules. There will be transitional arrangements to ensure that you are taxed on all profits up to and including the 31st of March 2024. This can therefore be more than 12 months of profits and will lead to higher taxes and a good chance that more will be chargeable at a higher rate of tax than if the rules were not changing. HMRC have said you can spread this additional tax over 5 years, but when you look at an example, it still means that you're going to be losing out here. The important point here is that in the 23-24, the profits of the 12-month period to 30th of June 2023, and also for those for the 9 months through to 31st of March 2024, will be assessed in one tax year. So this means that the personal allowances are lost in that year and the tax is paid at the marginal rate of 60% on more than £25,000 of the profits, which ordinarily would only have been taxed at 40%. And of course, if it were not for the ability to spread the additional tax over 5 years, the cash flow and timing of the tax payments would increase significantly. So planning is key, budgeting for cash flow is key. Take advice where you're a self-employed or a partner in a partnership and your accounting date is not the 31st of March. The government expect this to raise a further £820 million in 2024-25. Moving on to VAT, very strangely there were no real changes to VAT in this year's budget. A quick reminder, hospitality currently 12.5%, increases to 20% from 1st of April 2022. We have not seen any extension to that deadline or timeline. VAT in the construction industry, a reminder, reverse charge is currently out there. It's operational. Please ensure you're abiding by the rules. Corporation tax rates normally paid for a small and medium enterprise where your profits are below £1.5 million, payable 9 months and a day after the end of your accounting period. What we have here is an increase as to when you might have to pay it, because the quarterly instalment regime is going to be extended so that the limits are split between all those associated companies rather than just group companies. It's group companies, 51% group companies that are affected at the moment and included, and that's expanded to associated companies. An associated company is basically one that controls another and under the same control of the same person or group of persons. Finally, I'm just looking at HMRC administration points here, clamping down of tax avoidance promoters. We have a little bit about this most years. This is again the case this year. HMRC can now freeze assets, charge penalties on UK entities that support offshore promoters, close down the promoters and share information on promoters and their tax schemes to discourage taxpayers from taking the advice and taking any of the schemes. Discovery assessments. These are assessments where HMRC can make provision to make good to the Crown any duties where there's not been a full disclosure or where new facts come to light. It extends the normal 1-year time limit that they have to look at an inquiry into a return up to a maximum period of 20 years. In the last few years, there's been several challenges where assessments have been raised on the high income child benefit tax charge, on gift aid payment tax charges, or on pension tax charges, because people have taken the view that HMRC know this information. Their computer systems should talk to one another. HMRC take a different view, and they've now legislated to make sure that they can raise discovery assessments to collect these additional charges. Large companies, over £200 million of turnover or a balance sheet over £2 billion, are having an ongoing encouragement for them to have an open and transparent relationship with HMRC. It requires them to disclose where a provision is made for any uncertainty or where tax treatment applied is not in accordance with HMRC's known position, so that these issues can be discussed and resolved early. They only affect where the tax advantage is over £5 million, but this is a huge principle involved here. Our tax system is built on the principle of self-assessment. And this departs from that principle completely. It affects large businesses only currently, but if this is extended, it could change the relationship most companies have with HMRC materially. Finally, the Office of Tax Simplification. Graham mentioned them earlier about their reviews that they've undertaken on capital gains tax and inheritance tax. And basically, they basically look at a subject either at the request of the Chancellor or on their own accord. And they're an independent office of the HMRC Treasury set up back in 2016 to offer advice on the simplification of our tax system. What they've done here is increased more independent members onto that board, which I think can only be a very good thing, and I think it'll be very interesting to see how the development of the Office of Tax Simplification continues over the next few years. Thank you very much. I'm now going to hand you over to Lou. Thank you.